Let me guess. Feel like you should be investing your money, but every time you try to look into it, you're hit with a tidal wave of information. Confusing jargon and blinking numbers that just makes you want to close the tab and walk away. You're not alone. The stock market can feel like this exclusive club, and the biggest fear is that you'll make one wrong move and lose your hard-earned money. I've been there. I remember feeling so overwhelmed that I thought you needed a PhD in finance just to get started. But what if I told you it doesn't have to be that complicated? In this video, I'm going to give you a simple, step-by-step playbook for picking your first investments with real confidence. We're going to pull back the curtain on the market, show you the exact paths you can take, and walk you through how to start, even if you're working with a small budget. By the end of this, you'll have a clear, actionable plan to go from nervous beginner to confident investor. Before we get to the how, let's have a quick real talk about the why. Why even bother with all this? The answer comes down to one powerful and honestly slightly terrifying word: inflation. Think about it. $100 today buys you a certain amount of groceries, a tank of gas, or a decent dinner out. What could that same $100 get you 10 years ago? A whole lot more, right? That's inflation, and it's a silent thief that is constantly eating away at the value of your money. A savings account is safe, sure, but the interest it pays is almost always lower than the rate of inflation. That means every single day your money is just sitting in a bank account. It's losing its power. It's like you're trying to run up a down escalator. You might be moving, but you're still going backward. Now, I'm not telling you this to scare you. I'm telling you this to empower you. The problem is clear. Inflation is a constant drag on your savings. The solution? Investing. Investing is the single most powerful tool an average person has to not just fight inflation, but to leave it in the dust. It's how you turn the money you have into more money, letting your wealth build on itself over time. When you invest, you're not just parking your money somewhere. You're putting it to work. You're buying a small piece of the future success of the world's most innovative companies. It's the difference between stuffing cash under a mattress and planting a seed that can grow into a massive tree. Today, we're going to learn how to plant that first seed. Okay, so we've nailed down why we need to invest. Now, let's talk about the what. What are we actually buying? For a beginner, this really boils down to two main choices: picking your own individual stocks or buying diversified funds. Let's break them down. Option 1. Individual stocks. Picture the stock market as a giant supermarket full of companies. Buying an individual stock is like picking one single product off the shelf. When you buy a share of, say, Apple or Amazon, you literally own a tiny piece of that business. You're a part owner. If Apple's profits soar because they sold 1 billion iPhones, the value of your tiny piece of your stock is probably going to go up. It's thrilling because if you pick a winner, the rewards can be incredible. Anyone who was smart enough to invest in Nvidia back in 2020 is very happy today. But this path has more risk. That one company you bet on hits a rough patch, a product flops, a scandal breaks your stock's value, can nosedive. You've basically put all your eggs in one basket. Investing in individual stocks is for people who actually enjoy the research and are okay with taking on more risk for that shot at a higher reward. Option 2. Diversified funds. Now, what if you're not trying to be a hero and bet it all on one company? What if you'd rather have safety in numbers? That's where funds come in. Instead of buying one single item from that supermarket, imagine you could buy a pre-made basket that has a tiny piece of every single item in the whole store. That's pretty much what an index fund or an ETF does. For example, a hugely popular choice is an S&P 500 index fund. This single investment holds stock in the 500 biggest, most successful companies in the US. With one click, you instantly become a part owner in Apple, Microsoft, Amazon, and 497 other giants. The magic here is diversification. One company in your basket has a terrible year, it's cushioned by the 499 others that might be having a great year. This massively lowers your risk compared to just owning one or two stocks. Your results will basically track the average performance of the entire market. For this reason, index funds and ETFs are what almost everyone recommends for beginners. They're simple, cheap, and give you instant diversification. The perfect set-it-and-forget-it way to build wealth. So quick recap. Individual stocks have high potential reward, but also high risk. Index funds have much lower risk, broad diversification, and solid market average returns. For 95% of beginners, starting with funds is the smartest and safest way to go. Alright, this is where it gets real. Let's walk through the exact practical steps to make your very first investment. It's much easier than you think. Step 1. Open a brokerage account. First things first, you need a place to actually buy your investments. You can't just call up a company and ask for a share. You need a broker. Think of a brokerage account as your personal gateway to the stock market. This used to be a headache, but now it's incredibly easy. For beginners, you just need to look for 3 things. 1. Zero commission fees. You shouldn't have to pay a fee every time you buy or sell. Most big online brokers offer this now. 2. No account minimums. You don't need a fortune to get started. Find a broker that lets you open an account with $0. 3. Fractional shares. This is a total game changer. It means you can buy a slice of a share. A single share of Amazon might cost hundreds, but with fractional shares, you can invest just $10 or $20 and own a piece of it. This makes investing accessible to everyone, no matter what your budget is. Opening an account is like signing up for any other website. It takes about 15 minutes. You'll need some personal info, like your social security number for taxes. And then you just link your bank account to transfer money in. Step 2. Decide your path and find your investment. Once your account is open and funded, it's time for the fun part. Deciding what to buy. Like we talked about, you've got 2 main paths. Path A, the simple and diversified path. This is the set it and forget it move. You're going to buy a broad market ETF or index fund. Inside your brokerage app, you'll use the search bar just like Google. You can type in things like S&P 500 ETF. This will pull up funds that track the 500 biggest US companies. Total stock market ETF. This is even broader. It's giving you a piece of thousands of US companies, big and small. A classic example is the Vanguard Total Stock Market ETF. You'll see a ticker symbol, a short code of a few letters like VU or VTI. You select that, decide how much you want to invest, and you're done. With one purchase, you've achieved instant diversification and are now invested in the overall American economy. It's the simplest, most effective way for a beginner to get started. Path B, the hands-on stock picker's path. Maybe the idea of picking your own stock sounds exciting. That's awesome. Just be smart about it. A good rule of thumb is to put most of your money, say, 80 to 90% in those safe, diversified funds, and use a small chunk to invest in individual companies. So, how do you pick a stock? The best advice for a beginner is to invest in what you know. Start with blue chip stocks. These are massive, stable, financially sound companies with a history of reliable performance. Think about the brands you use and love every day. Reading this on an iPhone. Good look at Apple. Get packages from Amazon every other day? That's another one. Do you shop at Walmart for groceries? These are huge, profitable companies that aren't disappearing tomorrow. Many of these blue chip companies also pay dividends, which are small, regular cash payments they give to you just for owning their stock. It's like getting a little thank you check in the mail a few times a year. For a beginner, start by asking simple questions. Is this a brand everyone knows? Are they a leader in their field? Do people keep buying their stuff even when the economy is shaky? You don't need to get lost in complex financial reports just yet. Stick with the giants you already understand. Step 3. Place your order. You've picked your investment. Now, let's buy it. You'll hit the trade or buy button and you'll have 2 main choices, the amount and the order type. Thanks to fractional shares, you can just type in a dollar amount. Want to put $50 into an S&P 500 ETF or $25 into Apple? Go for it. You don't have to worry about the full share price. Then you'll see order types like market order and limit order. A market order just means buy it for me now at the current price. It's simple, and it's perfect for long-term investors. A limit order says only buy it if the price falls to X amount. It's a bit more advanced and not something you need to worry about for your first purchase. Choose market order. Enter your dollar amount, click buy, confirm it. And that's it. Congratulations, you're officially an investor. You own a piece of a business or hundreds of them, and you just took a huge step for your financial future. Knowing the steps is one thing, but it's totally normal to still feel that pit in your stomach. The fear of losing money, of it being too complex, of the unknown. Let's tackle those head on. But what if the market crashes right after I invest? This is the number one fear, and it's a fair question. Market crashes are a normal, unavoidable part of investing. Happened before, and will happen again. But here's the most important fact. Historically, the stock market has always recovered. Every single crash, the dot-com bubble 2008, the 2020 pandemic drop, was eventually followed by a recovery that pushed the market to new all-time highs. You have to shift your mindset. You're not a day trader, you're a long-term investor. Your timeline for this money should be at least 5 years, and ideally much, much longer. When the market drops, you only lose money if you panic and sell. In fact, smart long-term investors see downturns as a sale, a chance to buy their favorite investments at a discount. The real secret to making money in stocks isn't timing the market. It's time in the market. I just don't have enough money to make a real difference. That's a myth. With zero commissions and fractional shares, you can start with $100, $50, or even $5. What's more important than the amount you start with is the habit you build. Starting early is way more powerful than starting big. Why? Because of the magic of compound interest. Your money earns returns, and then those returns start earning their own returns. It's a snowball effect. A small amount of money you invest in your 20s has the potential to grow into a much larger sum than a bigger amount you invest in your 40s, simply because it had more time to work its magic. The key is to start now, no matter how small, and invest consistently. It's just too complicated. It feels like gambling. It can definitely seem that way from the outside. But as we just saw, the core strategy for a beginner can be incredibly simple. Buy a diversified, low-cost index fund and hold on to it. That's it. You don't need to read charts or follow the news every second. And investing is not gambling. Gambling is a bet against the house with the odds stacked against you. Investing is about owning a piece of the long-term growth of the global economy. You are betting on human ingenuity, on progress, and on the fundamental desire of good businesses to grow and make more money over time. While there are always short-term risks, the long-term trend of the market has historically always gone up. We've covered a lot, so let's boil it down to the simple, actionable steps you can take today. 1. Open a beginner-friendly brokerage account. Look for zero commissions and fractional shares. 2. Decide your path. For most beginners, the smartest and safest choice is to buy a broad market index fund or ETF that tracks something like the S&P 500. 3. Start small and stay consistent. Building the habit is more important than the amount. If you can, set up automatic monthly investments. That's the blueprint. You now know more than the vast majority of people who are too intimidated to even try. The most important thing you can do now is take that first step. The fear might not vanish completely, but confidence is built by doing. Your first investment, no matter how small, is a powerful vote of confidence in yourself and your future. If this video helped clear things up for you and gave you that push to get started, do me a favor and hit that subscribe button. I put out new videos every week to help you stay on track and build your wealth. And now that you know how to buy your first stock, you're probably wondering what mistakes you need to avoid. I've got you covered. I made a whole video on the 5 money rules every beginning investor needs. Click the link on your screen to go watch it now. Thanks for watching, and I'll see you in the next one.